Hello guys, welcome back. I hope you're having a nice weekend. We're going to take a look at Best Buy, a very well-known, massively well-known chain in the US. And this one has been down about 50% from its one-year high, also annihilated with the rest of the market pretty much. If you take a look at the stock news here, you will see that there are some articles discussed here, like for example this one, can Best Buy grow sales in 2022? And you will see that they are expecting that sales will likely fall this year, with the hardest hit occurring in Q1. And they call for a rebound by fiscal 2025, actually. That's a little bit far away. But as you'll see here, we're expecting the announcement, the earnings announcement pretty much, to happen at Tuesday, May 24. Very interesting here, and we're going to be covering it once it's out. Now, if I was an investor looking to invest in Best Buy, I would wait for this earnings report, because it's very likely that the stock may get annihilated with the rest of the market, as a lot of retailers have. Now, it's not a certainty, of course, but you may want to wait, because we have seen insane declines, and so it may not be the best idea actually to buy the stock right now. So it may not be the best buy right now for you. So if we take a look at the max chart here, you will see that generally speaking, Best Buy has been doing tremendously well, been going higher and higher. Of course, some years there has been a little bit of a slump, but in the latest market boom, it has been doing better and better. Now it's down significantly, but let's take a look at what is going on with the financials. A P/E ratio of 7 here, very nice to see, and going down and down and down here, and a price to free cash flow ratio of 6.47. Outstanding shares that keep going down as well, another very nice thing to see, because the company is buying back shares like crazy, really, 25%. And their total liabilities to free cash flow ratio is actually 5.7 here, which means that the company has quite a lot of free cash flow to pay back their total liabilities. Now, ideally, you will see here, I want this to be near 5 or so. Actually, I need to add this, but I want it to be near 5, and this one is actually 5.76, so it's very close and it's probably fine. We will examine that in a little bit more detail. Revenue growth of 22%, almost 23 here. Net income growth of 145%, insane increase in net income here in the last 5 years. Very cool to see from the company. Free cash flow growth as well. Total equity growth is going down. I'm assuming because the company is buying back shares like crazy is probably why total equity is going down, but that's not a bad thing, because there are less shareholders since there are less outstanding shares. So all the equity that the company generates can actually be distributed to more stockholders. So it's a good thing. And the outstanding shares are actually decreasing more than the total equity growth is decreasing. So the debt to equity ratio 1.07, slightly elevated, but it's probably still fine. The margins are low for this company, but look at this dividend yield, very hefty here, 4.1, and just a 27%, not even a 27% payout ratio in terms of its free cash flow here. And that's amazing to see with such a hefty dividend yield here. I love to see that. Let's take a look at how this has been increasing over the years. These are probably special dividends, I would say, over here, but overall, there has been an increase in the dividend that the company is paying. This is probably another one that is a special dividend. But overall, as you'll see, since many years now, there has been a substantial increase in what the company is paying back in dividends. Very cool to see from the company. The current dividend yield based on its price, on the price, is actually 4.8%. Very coul. Okay. Remember that this dividend yield tells you what is the current dividend yield based on the current price that Best Buy is trading at. But the dividend yield TTM is the last 12-month ones, sort of like an average. Very interesting. The company looks very nice in terms of what they are doing, but let's examine a few details here. 42 billion to 52 almost over here for Best Buy in terms of revenue. And in terms of the net income, look at this one, 1.1 billion here to 2.4 billion. That's a very good growth, as you can understand. 1 billion to 2.4, it's nothing to sneeze at. Very nice for the company. It keeps increasing its net income here. Now the balance sheet, you will notice that we're going to be having some equity that is going down here, and that makes a ton of sense, because the company has been buying back shares like crazy. As you can understand, we have talked about it, and so you will see that in the assets of the company basically going down, because they have been spent to buy extra shares, pretty much. And so this is what is happening here with the company's assets. And as you'll see here, their net cash provided by operating activities is also very, very positive, 3.2 billion. And the last year it was a little bit better, as you can see, but there was a one-off change in working capital that caused that. And a lot of depreciation and amortization going on as well for the company's expenses. Now, capital expenditures consist of the majority of investing activities here, and some acquisitions also for the most part. But capital expenditures is the thing. Some dividends being paid here, but look at this common stock repurchase here. What I was telling you earlier, the company is buying back shares, like tremendous amounts of shares, and that's good for investors. That's good for investors of the old days, especially because they are getting more for the shares that they are already holding. And as you'll see here, they are still increasing their cash even though they are buying back so many shares. Very interesting. 1.4 billion in free cash flow to 2.5 billion in free cash flow. This is very similar to the net income. So we're probably going to be having a field day here with our stock evaluation tool. Let's examine what to expect from this company and whether it's cheap or not. Okay, so revenue growth of 5, 6, and 9 over here. You will see that we have had a couple of years where revenue growth was low. I'm gonna go a little bit lower than this. Let's just go 2, 4, and 6 for this one. And net income margins, they're about the same pretty much every year. Their margins, so we're gonna go, they're a little bit better actually this year. Let's just go 3, 3.5, and 4. This may be actually a little bit too conservative. We'll see, maybe we can actually make it a little bit higher, depending on what we get. So free cash flow margin over here, overall I'm seeing, something like 105, 100%. So I'm gonna go 100, 105, and 110 here. And an annual return of 13% is what I want to be making. Now again, the average here has been a little bit higher, but that's because of mainly this year, basically. And it is the one-off that we talked about earlier in changing working capital. So if we hit calculate, as I would expect, we're getting that the current price of the stock is actually fairly low for what the company is worth. So even buying this one at $100 would actually be a green here. Interesting. I didn't expect Best Buy to be that cheap really, and I'm beginning to like it more and more as I'm seeing here. And so if we get a earnings report that actually brings it down even lower, that would give me an even better price to buy the stock. And based on the financials, the company is doing really well here. So I like what I'm seeing a lot here for this company. Not a lot of debt as well. Remember that we're taking a look at the total liabilities here. Let's examine that. Total liabilities were 14.48 billion, and remember that the free cash flow that the company generated last year was 2.5. So it's about 5 to 6 years basically of free cash flow. Actually, we know the answer to that if we take a look at our stock analysis tool here. It's actually 5.76 exactly years of free cash flow that it would take to pay back our total liabilities. That's the last year's free cash flow. So the company is pretty solvent. It's doing great. It's buying back shares. I love what I'm seeing here. It's increasing its bottom and top lines. So I would seriously be considering to buy Best Buy. But again, I will wait for the next few days because it may go down lower. But this one is definitely getting an upvote for now. So thank you for watching the video. Tell me what you think about Best Buy. Are you thinking about this company? Have you actually thought about them? So this one looks interesting. And leave a comment and let me know of your thoughts about this one. And thank you for watching it. Thank you for watching the video. Remember to like and subscribe. You can always also become a Patreon and get access to our tool here. Unlimited, of course. And you can find links in the description box below for that. Thank you for watching this video, and I'll see you in the next one, guys. Bye-bye.